New York was once a modest port city, small, limited, and dependent on trade coming from Europe. Today, New York is counted among the most powerful economic capitals in the world. What happened that this city on the edge of the Atlantic became the capital of opportunity in a few centuries? So let's know this amazing journey to New York from the beginning, and know how it became the financial capital of the world. Chapter 1. Colonial Foundations. In the 17th century, the Dutch East India Company established a small trading base on the southern part of Manhattan Island called New Amsterdam. There was a trade in furs and timber, and a fort was built for protection. In 1625, it was made the capital of a Dutch colony called New Netherland. With the increase of trade, the population also increased here, and by 1664, about 9,000 people were living here. That same year, the British occupied the area and renamed it New York. Even under British rule, the city grew rapidly as a major port and trade center, and it was from here that money and business on Wall Street began. Chapter 2. The Rise of Trade and Commerce. New York's natural harbor and open trading environment in the 18th and 19th centuries made it a fast-growing trading city. By the year 1800, New York had become the largest business center in the country, surpassing all other cities in America. In 1825, the Erie Canal was built, connecting the Atlantic Ocean to the Great Lakes. This greatly reduced the cost of transporting goods and made trading easier than ever. Because of this canal, New York became the main trade route between the United States and the world. By the mid-19th century, the Port of New York became the busiest port in the country, and along with it, new trading cities such as Albany, Syracuse, and Buffalo began to develop rapidly. Chapter 3. The Rise of Wall Street. Wall Street has been a major center of money and business activities since the time of New Amsterdam. It got its name from the wall that was built in the 17th century to protect the city. In the 18th century, there was a trade-off of slaves and early shares. In the year 1792, 24 prominent traders on Wall Street signed an agreement called the Buttonwood Agreement. This agreement led to the beginning of the New York Stock Exchange. After this, from 1793, these merchants started buying and selling shares regularly at the Tontine Coffee House. Gradually, Wall Street became the largest center of America's financial world. Chapter 4. Industrial Age and the Evolution of Banking. As industries began to grow rapidly in the 19th century, New York's banking system also became stronger. In the year 1812, Samuel Osgood started the Citibank of New York, which we know today as Citibank. These banks provided money for the construction of railways, setting up factories, and the development of cities. Despite the financial crisis of 1837, New York's banks continued to thrive. When rail lines began to be laid to the western US in the 1840s, large companies needed huge capital, which led to the addition of new companies to the stock market. At the same time, new types of markets also formed on Wall Street. With the advent of new technology like the telegraph, information about stock prices began to reach very quickly from one place to another, making Wall Street's trading faster and more effective than before. Chapter 5. The Panic of 1907 and the Establishment of the Federal Reserve. The financial crisis of 1907 made it clear how dangerous it was to not have a central bank in America. The stock market crashed in October 1907, forcing many New York banks and trust companies to cease operations. The situation worsened so much that famous industrialist J.P. Morgan and other big bankers had to save the banks by investing their personal capital. Otherwise, the crisis could have been deeper. This incident made the government think that a strong central bank is necessary to handle the country's financial system. This thought led to many discussions, and finally, on December 23, 1913, the Federal Reserve Act was passed, under which the Central Bank of the United States, the Federal Reserve System, was created. Chapter 6. Great Depression. The rapid economic growth of the 1920s was followed by a major crash in the New York Stock Exchange in 1929, which plunged not only the United States, but the whole world into a serious economic crisis. The Dow Jones Index was at its highest level in September 1929, but suddenly fell drastically in October. On October 28, the market fell by 13%, and the next day it fell by another 12%. In a few months, the share prices halved, and by July 1932, the market was down almost 90% from its old peak. The impact of this decline on ordinary people was profound. By 1933, about 25% of the people in the United States were unemployed, and thousands of banks were closed. The crisis was not limited to the US. The economy of the whole world weakened. Global trade was halved, and many countries like Britain and Germany were also stuck in a deep recession. Chapter 7. Post-war domination. After World War II, the United States became the most powerful economy in the world, which further increased New York's financial importance. In 1944, the Bretton Woods Conference took place, in which 44 countries came together to form a new global economic system. In this arrangement, the US dollar was pegged to gold. That is, the price of every dollar was fixed at $35 per ounce of gold. During this period, major international institutions like the IMF and the World Bank also started. In this system, the currencies of the rest of the countries were pegged to the dollar, making the dollar the most trusted currency in the world. The US was considered a major financial country to help other countries when needed. This arrangement lasted until 1971, and it was during this period that the US dollar became the world's main reserve currency. Chapter 8. Investment Banking and Corporate Finance. In the 1980s, with the easing of financial regulations and the advent of new technologies, Wall Street began to move quickly. Interest rates came down, people's money in retirement plans started coming into the stock market, and investment from abroad also increased, which led to a boom in the stock market. Between 1980 and 1987, the Dow Jones Index nearly tripled, and jobs in New York's financial sector also doubled. The development of computers and the internet in the 1990s propelled tech companies exponentially, causing the Nasdaq to multiply. During this period, there was a big jump in both the number of people working on Wall Street and their salaries. At the same time, large investment banks such as Goldman Sachs, Morgan Stanley, and Lehman began to make billions of dollars from deals such as mergers, acquisitions, and IPOs, and their dominance became stronger. Chapter 9. Hedge funds, mergers, and the power of Wall Street. The 1990s and 2000s saw new financial methods on Wall Street that had high profits, but also great risks. Mergers and acquisitions of large companies began to take place rapidly through methods such as junk bonds and leveraged buyouts, which greatly increased the earnings of investment banks. At the same time, the hedge funds business also expanded rapidly and became a multi-billion-dollar industry. Today, the money invested in hedge funds around the world has reached trillions of dollars. Large New York financial companies played a key role in creating and running these hedge funds, further strengthening the power and influence of Wall Street in financial markets around the world. Chapter 10. Technology, Fintech, and Digital Finance. In the 21st century, New York did not just limit itself to traditional finance, but also moved rapidly in the field of technology. Many tech startups started in areas like Manhattan's Flatiron, which came to be called Silicon Valley. Here, new technologies such as artificial intelligence, fintech, internet, digital media, and cryptocurrencies began to be worked on. The New York Stock Exchange is still the largest stock exchange in the world, where money from all over the world comes for investment. Digital payments, online trading, and new financial products have made New York a major center of modern digital finance. Chapter 11. Rivalries and Challenges. Today, Wall Street is facing stiff competition from the world's other major financial centers. Cities such as London and Hong Kong have also become increasingly strong financial hubs. Even though New York is still number one in the global financial ranking, its gap with the rest of the cities is now narrowing. In addition, new and stricter laws in the US, such as the Sarbanes-Oxley Act of 2002 and the Dodd-Frank Act of 2010, have tightened regulations on banks and financial companies. Tax regulations, government surveillance, and global economic changes constantly force New York to change its strategies to remain the world's top financial center. Chapter 12. The Future of Finance. Even in the digital age, New York remains a major financial center in the world. There is now a rapid increase in investment in blockchain, digital currency, and fintech. The New York Federal Reserve launched an initiative called Project Cedar, which tested ways to make payments faster and safer between countries using blockchain technology. This experiment made it clear that blockchain-based systems can make transactions more reliable in less time. In the coming time, artificial intelligence, cryptocurrencies, and other digital technologies will also bring new challenges and new opportunities for New York. Through these innovations, New York is showing that it is ready to maintain its leading role in the world of digital finance as well. If you enjoyed this enlightening journey, don't forget to like and subscribe to the video.